This is the first of a three-part workshop, and I'm going to give all three parts of the workshop today. Now, I know there's a lot of different speakers here. I met most of them last evening. I think the topics at all of them are going to be good, so I'll understand if you all don't make it back to the other two sessions, but if you can, that would be wonderful. And I also understand that they're recording all these sessions anyway, so we'll be able to pick up on anything that you miss. But this particular program, these three different programs are designed to work together. So the first part we're going to do right now is about how to evaluate income properties, right? I mean, it's wonderful to go out and buy income properties. The challenge is how do you know a good one from a bad one, right? So I'm going to give you some nice tricks and tips on how to do that. The second part, which I think is that right after this one, in the same room, I'm going to teach you how to integrate real estate into a financial plan. As Steve Olson was saying, this is one of the things I do as a financial planner is recommend real estate as part of a portfolio because it is a great investment, right? That's why we're here, right? We all love real estate. So I'm going to show you how to do that. And then the third part is how to own real estate when it's not in your local market, right? So I live down in the Newport Beach area, California. There's nothing there that makes sense as a rental, right? It's just ridiculously expensive, and you can't get ridiculously high rents for it, so we have to manage everything from afar. And I have clients all over the country, from Honolulu to literally Florida and New Hampshire and Washington State. I think even have somebody in Alaska. So my clients own real estate all over the country, and you know, I own a place in Park City, Utah, right, 700 miles away. So we're going to talk to you about how to do that. So all three of these things are what we're going to talk about here. Couple other things. This is a workshop to teach you stuff, okay? So I wore my professor's outfit, right? I got my sweater on. Don't have patches, though. Didn't have the patches. But my point is this. I want you to interrupt me constantly with questions. That's totally okay. I have like 20 slides to go through. I don't care if we go through 2 of them, right? So if you have questions, just raise your hand. We'll address them right on the spot. Make sure, in case I do forget, to ask me to repeat the question because those in the back of the room may not hear you ask that question of me, and certainly on the recording as well. But it's more important for me to interact with you and help you learn stuff than it is for me to get through my whole PowerPoint. That makes sense? And one other thing, I'm going to be recording this, all 3 of these workshops separately, done as a webinar, which you'll be invited to listen into as well. And those recordings will be posted to the website. Right? So you have an opportunity to see them again and share them with your friends. Okay? Any questions so far? All good? Nobody has a question. Then we're going to get rolling here. So I want to ask you, first of all, how many people in this room, and I have a good idea from seeing this morning, how many of you already own investment properties? Wow. All right, so now keep your hands up, right? So how many of you would like to start to own some investment properties? All right, now I got them all, right? I got everybody in this room, and that's why you're here. And, you know, a lot of times when I, thank you for sharing by that way, a lot of times when I go to events like this, the room, there's maybe just a handful of people, right, that do that. Because you guys are here for a specific purpose, but in general, mom and dad and sister and brother, you know, they hear about real estate, but they, you know, the Robert Kiyosaki and all this kind of stuff, and they think it's too hard and too complicated. And their guy at Merrill Lynch says it's terrible investments anyway, right? You should invest in a REIT if you want to own real estate, right? That's a better way to own real estate, right? So my question to you is this. If there was really a better, smarter, and safer way to find real estate, buy it, to evaluate real estate and manage it, and we talked about that for the next 30 or 40 minutes together, would that be a good use of our time? You agree? Yeah, me too. So that's what we're going to do. I'm going to show you again how to financially evaluate income property, how to integrate real estate into a financial plan, and then finally how to find, acquire, and manage real estate when you don't live nearby it. So, got this. That's a duplicate slide. Am I going in circles here? No, I'm not. Okay. For those of you that don't know, there's a guy, I think, speaking in the next room there. His name is Mark Kohler. Anybody know Mark Kohler? Heard Mark Kohler before? Yeah. So Mark and I co-authored this book last year. It's available on Amazon. It's going to be a few copies I have available out here as well. But Mark and I have been working together for the last 6 years. We give a series of workshops in the fall all around the country. And so this particular book, Financial Freedom, What Wall Street Isn't Telling You, I'm going to have a lot of little things I'm going to talk about today that are in that book. And so you'll see a little mini book inside that slide. I won't say, hey, there it is all the time. I might mention it again. But if you want to get more detail, go deeper, because again, I only have 30, 40 minutes to talk about the topic. It'll be in the book, okay? So it's a good thing to do. So what we're going to learn, evaluate, we talked about that. We're going to focus on evaluation right now. Another housekeeping thing, this is my disclosure, okay? Now, I will say, and I'm guilty of this, most of the time when you talk to a financial advisor and they throw this disclosure on the wall, they just laugh it off, right, and they move on, right? Because it's a lot to read. But I really want to focus on this part right here. Investments are subject to risk, including market and interest rate fluctuations. Investors can and lose money, and unless otherwise noted, not guaranteed, right? It's important, right? You're investors. You need to be smart. You need to be good stewards of your money, right? Because nobody's going to protect your money more than yourself. Myself, I'm a fiduciary, right? I'm responsible to do the best things for you. That's my job. My primary function is to always make decisions that are in your best interest. But rest assured, as good as I'm going to do for you, you're still going to do better if you watch over it. So pay attention, and this is, again, why you're here learning today, right? We want to be good stewards of our money. So I want to talk to you about a concept, and this is in the book. I think that, yeah, it's in the book. See the little book in the upper hand corner? About the 3 states of money, okay? Now, how many can remember back in high school, I think it was physics class or maybe chemistry, the 3 states of matter? Anybody? 3 states of matter? You remember what they were, Curtis?
Sure, gas, liquid, solid.
Gas, liquid, and solid, right? So all of matter in the universe exists in one of these 3 states. And what's also important to understand is it only exists in one state at one time, right? It can't be gas and liquid at the same time or solid and gas. It's either gas, liquid, or solid. That's it. Money has the same thing. It's in 3 states. And and what I mean by that, there's only 3 things you can do with it. You can spend, you can lend, and you can invest, okay? There's nothing else. Now, you can call it all kinds of different things, all different descriptions of what it is, but it's always going to boil down to one of those 3 things. So, spending, let's talk about that. When I spend money, we don't think about the rate of return on when we spend things, right? We buy things, right? We buy, this bottle of water, right? But there is a cost associated with it that goes beyond the actual dollars you pay for it. You know what that cost is? Opportunity cost, exactly. So if I have a lot of clients that are so proud, God bless them, they're so proud that they own their homes free and clear. I mean, it's a wonderful thing, and it actually does help when you go into retirement if you have, free and clear real estate. But they think that, because they own it free and clear, it's not costing me anything. It's not true, right? Because if I have $100,000 in the bank, and let's say I'm earning 5% interest, $5,000 a year. If I take that $100,000 and pay off the mortgage on my home, I no longer have a mortgage payment, but what did it cost me? $5,000, right? So spending has a cost associated with it. You're going to lose the opportunity to make money from that money forever, right? Taxes. When you pay taxes, you lose the opportunity because you gave that money to the IRS for that money to earn money forever, right? So spending is one of the states of money, and it has negative consequences. My point here, everything is 100% financed. Think about that for a minute. If I buy that bottle of water for $5, I bought it, but what did I really do? I financed it with my money, right? When I paid off my mortgage, I now own that house free and clear, right? But I'm now the financier of my home. There's always a cost. There's always an opportunity cost associated with it. So we want to be aware of that. Doesn't mean you shouldn't spend your money. There's stuff we may be thirsty, right? We may need some water to drink. We may be hungry. We maybe want to go on one of those cruises that they're advertising downstairs that look like a lot of fun. We can do that. I mean, that's why we work. But there is a cost associated with it. Lending. This is a little more tricky. Okay, so I go to all right, banks are just so good at making us feel really good about doing really dumb things, okay? So you go to the bank, and what do? You make a deposit of your money into their bank account, right? And a deposit, feels so good, right? It's a warm, positive feeling thing. I put money in the bank. Now, what did you really do? Anyone? You loan money to the bank. By the way, how much interest do they pay you for that money in your checking account? Zero. I was having lunch today with somebody and they said they wanted to get money for nothing. That was what their goal of being here today was, or one of the things they wanted to do. I said, that's not going to happen. I said, unless you're a bank, right? Because a bank, I can put millions, billions of dollars people give to them every day, lending them their money, right, in exchange for no rate of return, right? So lending is, again, it's almost perverted because they make you feel good. Anybody know what a bond is? Anyone? Right? It's a loan, right? Now, if you were asked to lend, I don't know, some corporation that you never heard of before, your money, right? Whether it's $5,000 or $5 or $150,000, you'd want to know all kinds of things about that company. You want to know their financials, you want to know who the owners are, you'd want to know all these important things about that company that you're lending your money to. But if you go to your stockbroker and they say, hey, I got this bond, it's paying 10%, do you want to buy it? Buy, right? That's a positive thing that makes you feel good. And it's a bond, right? So you feel good, you got security, you got what? You loaned this company money, right? So, okay, this is another one. Look in your wallet. Did anybody have any dollar bills in their wallet? Okay. Now, if you look at, now first of all, what's a bill? A bill is a short-term loan, right? And if you look at it, it says treasury note or bill, right? You basically loan money to the federal government, your money to the federal government, again, at what rate of return? Zero, right? All those dollars you got in your pocket, you loan to the federal government at 0%, right? But it feels good because you got that greenbacks in your pocket. You see how this works? Money can't not do one of these three things. It has to be spent, it has to be lent, right? Or it has to be invested. And investing means ownership, right? So if you think of saving and investing, saving means lending. That's all it is. Saving means lending. It just makes you feel a little better about it. And then ownership is investing, right? We invest in real estate. We invest in stocks and bonds. You do own an interest in that company, you know, like this little bit of Apple, this little tiny little bit of Apple you own, right? You own it. You have no control over it, but you own it. You do own it. So 3 states of money. Okay. So let's talk about the stock market, first of all. I am, by the way, I'm a registered financial consultant, RFC. I'm an investment advisor representative. I'm a certified wealth protection planner, certified Medicaid planner. I've been a mortgage broker for 32 years. I'm a real estate broker. I'm a securities broker and a life insurance agent, right? So I do everything except I'm not an attorney, I'm not a CPA. That's why I hang out with Mark Kohler, because guess what he is? Attorney and a CPA, right? It's a good marriage. When people come to me and they talk to me about their investments, usually they think of the market as the stock market. Would you all agree? Is that fair? Right, stock market? And when they think of the stock market, they tend to think of what? The Dow Jones Industrials, right? You see it on the news every night, right? Dow Jones Industrials up, 100 points or down 500 points, depending on which way the news goes that day. Now, this is what most people don't know about the Dow Jones. The Dow Jones, first of all, is not the market. It's only 30 companies. There's over 4,000 or 5,000 companies that make up the whole New York Stock Exchange. The New York Stock Exchange is not the only stock exchange. There's the Chicago Stock Exchange, there's foreign stock exchanges, there's many exchanges where companies shares trade. That was only 30 companies. Why is it such a big deal? Well, it's such a big deal because the Wall Street Journal owns the Dow Jones Industrials name, right? And who's the voice of Wall Street but the Wall Street Journal? Right? So they're just marketing their brand over and over again to us to make us think that that is the market, right? By the way, Wall Street Journal is owned by News Corp, and guess who owns News Corp? Rupert Murdoch, right? He owns everything, everything media, right? So that's why you see that on the news over and over and over again. It's not the market. What is the market? The S&P 500 is a much better representation. For those of you that don't know, S&P, Standard & Poor's 500 are the top 500 companies on the New York Stock Exchange ranked by their market capitalization, meaning how much they're worth, right? So those 500 companies make up 80% of the net worth of the entire New York Stock Exchange. They really are the market. So what happens with the S&P 500 is important, is relevant. That, by the way, also is a little skewed these days because the top companies in the S&P 500 are so big that they really overshadow so many of the ones underneath. And little changes in Apple stock or the big bank stocks can have a really big impact on the whole S&P index, which makes it hard, by the way, to do the exchange-traded funds where you just have an S&P index because you're really buying in like 10 or 20 companies. Right, again, back to this Dow Jones Industrial thing. But this is what most people think of as the market, okay? I looked up some statistics to bring into us today. Since 2007, this is really interesting, 55% of the investors that invested in the stock market have lost more than 50% of their money. Now, they've gained most of it back, right? Or if they hung in there, if they didn't need to spend it, they gained most of it back, but that's a lot. You know, if I had an investment and I said, hey, this investment is like so really awesome and safe and cool, and I'm Merrill Lynch, and I got a great brand name, I've been around forever, but half of you are going to lose half your money, would you do it? I don't think so, right? Only 13% made a profit between 0 and 20%, and only 4% made a profit greater than 50%. How many of you guys own real estate again? Yeah, how many of you have seen returns like that on your real estate investments over the last 10 years? None, right? Because real estate doesn't work like that. Real estate doesn't work like the stock market, which is why we like it. By the way, just because I'm telling you this, again, stocks are not bad just because they're stocks. They're just another type of investment. Yes, sir?
What time period does that?
This started 2007 through 2017, I think, was the sample. Yeah, so it's a really bad time, right? I mean, 2008-9, that was a horrible year. Horrible year for real estate, too, right? And here's little Randy out there telling people, you should really be buying real estate now. This is in 2009, 2010. And all you heard on the news was, this guy lost his home and this lady lost her home. And, and it's like, no, they didn't lose their home. It didn't like run away. They chose to give it up, right? Or maybe they lost their job. Or a lot of times I talked with people that, they were the good mortgage person. They had a job, they paid their mortgage, they owned $250,000 on that mortgage, and they paid it every day. But the person across the street just bought their home through foreclosure, and now they got it for $125,000. And they're just wondering to themselves, why should they be paying their $250,000 mortgage because they were good when this other person just took advantage of the opportunity? So no, people choose to give up their home mostly. That's why they lost those homes. They didn't just lose them to foreclosure. It's just the way the news paints it, right? Again, making it safe to go back in the water with the sharks in Wall Street. So stocks are not bad. Life insurance isn't evil. I don't know if we'll have a chance to talk about life insurance, but we use it a lot. It's an awesome financial tool. And real estate, by the way, is not a magic bullet. Sorry. Okay? It's not perfect, right? It's just not perfect. It's a great tool, but it's not perfect. And my point, going back to that initial disclosure chart, right, the slide is investments, lending money, investing in things, all of this stuff comes with risk, right? You just need to be smart. You need to be educated, and that's why you're here today, and thank you again very much for being here for that. So why do we like real estate, right? Number one reason is that, right? Rate of return. Most of the folks in this room that have owned real estate for a while, you're looking at 10, 20, 30% rates of return on average if you bought it at the right time and managed it the right way. You also have great tax benefits. In fact, because tax planning, doing taxes, helping my clients save on taxes is one of the things I spend the bulk of my time on. I don't know of an investment as good as real estate for taxes. You get a deduction for just owning it through depreciation that's guaranteed by the IRS to pay you every year, year after year, for decades, right? I mean, that's pretty amazing in and of itself. There's not too many investments that do that. There's a couple others, but not many. And then if you sell your home at a profit, what do you get to do with it to not pay the taxes on it? 1031 exchange, right? Or use another thing called the deferred sales trust. Anybody ever hear of a deferred sales trust, by the way? A couple people? No, that's different. The question was it part of an opportunity fund? That's different. If we can have time to talk about opportunity funds that are new, just briefly, a deferred sales trust, think of it like a 1031 exchange, kind of on steroids. Because what do we love about a 1031 exchange? You don't have to pay the taxes, right? What do we don't like about a 1031 exchange? You have 45 days to find your new properties, right? Now you have 180 days to close. That's cool. But if you have 45 days to find properties, that can be tough. I had a client back in 2010 sold a beach. This is a great one. A beachfront home in Orange County. In 2010, when the market's just, horrible, right? They sold it for $5 million. Now, Grandma bought this place for about $32,000 back in the 1920s, right? It's just a little shack, happened to be on the sand, right? So we had $5 million that we had to 1031 exchange into little $150,000 homes, and we had to find all those little $150,000 homes in 45 days. And literally, they owned me for 2 months. We just scoured the country, came up with those, did a successful exchange on the entire. It was a big project. That was really big. So another thing we don't like about a 1031 exchange is how many of you have properties that have appreciated in value recently, right? A lot, right? So the market's hot right now. Do you think the market's going to correct at some point? It's cooling a little bit, a lot of markets, right? Where I live, homes go like this, right? I mean, they don't swim, but they go up and down in value. So if you're selling in a high market, what happens? You have to buy in a high market. And so, that's not cool, right? You made all this money because your real estate appreciated, and now you're going to sell it and overpay for the next stuff you're buying? That doesn't make any sense either. So what the deferred sales trust does, it allows you to sell your house, put the money into a trust, and then you can have literally decades to redeploy that money into real estate in the future or anything else. You could take that money and put it into a business. You could put it into stocks. You could do all kinds of things. And if anybody wants to learn more about the deferred sales trust, just send me an email, put DST in the subject line, and I'll send you a little brochure on it. 1031 on steroids, just in the way back of the room. And by the way, you got to talk really loud because I'm 66 years old next month or 2 months from now, so I can't hear you.
Just one quick question about the deferred sales trust. How much does it cost
For the deferred sales trust?
to actually load it into deferred?
Yeah. So, great question. So the question was, for a deferred sales trust, how much does it cost? That's another thing I want to say about the 1031. Relatively cheap, right? For a few $100, you can get this whole thing set up, and that's a beautiful thing. The deferred sales trust is going to be much more expensive, right? And it's really, it's about, let's say, 2% of the value of the asset to get into it. So if I have a $2 million asset, I'll spend $20,000 in legal fees to set up the trust, and I have ongoing expenses as well. Yes, sir?
How high up the IRS hierarchy is the trust approved?
Yeah, so the question was, how high up the IRS hierarchy is that trust approved? So, meaning, if it was audited, right, and the IRS was looking at it, would it hold up? Yeah, and the answer is, all right, again, this is good. We want to go down these rabbit trails. It's okay. If I get to one more slide, we're awesome, right? We'll get it all eventually. So the deferred sales trust is really a combination of an installment sale and a trust, okay? So follow this if you can. When I sell something on an installment sale, this is IRS code, been around for 80 years, right? If I sell something on an installment sale, it's like you sell a house, you carry back a note on it, right? I only pay the tax as I receive the money, right? That's the way it works. So the way the deferred sales trusts work, but if I sell something and I take back a note, I sell it on an installment sale, what's the biggest risk I take? Payoff, right? It defaults. My borrower, I'm now a bank, right? My borrower might default on it, right? So with the deferred sales trust, we take care of that problem because we basically sell the property to the trust. The trust sells the property to the third party. Now the trust has the cash in exchange for a note. So we took away the problem of the default because it's already liquidated. Now to answer your question, now all I have is a note to a trust, right, that's been around for 80 years, and that note is paying me a minimum of interest only, right? I don't even have to receive the principal for decades. Right, so that's how it works. And that's why it's so expensive, by the way, because you have to set up this multitude of parties. And it's a cool tool. It's not for everybody, but it's an option. And my point with this, and I'm going to get to your question in a second, with tax benefits, and when we finish the 1031 exchange story, what happens? We bought, we sold at a profit, we 1031. We bought, we sold at a property, 1031. And what eventually happens? We die, right? We die. And then our kids and grandkids get to inherit these properties, right, with a step up in basis under current tax law and pay no income tax at all on all those gains. It's awesome. I love real estate. I mean, you can't do that with stocks. You just can't do it. What was your question, ma'am?
About the trust.
The trust?
Yeah.
Yeah, that's not a question, though.
The TST, like a 1031, is it only on income property?
The question was, is a deferred sales trust like a 1031 only on income property? The answer is no. deferred sales trust can be on anything. It could be on stocks. It could be a business, a farm, right? It could be any type of highly appreciated asset. It could be on Bitcoin. I've had people with Bitcoin that wish they would have talked to me, before the big, crash into Bitcoin. I had a client last year that won the securities lotto. He had $250,000 as a part owner in a family-held business that sold for $2 billion. So his share was like $5.5 million, right? And he was really excited because his $250,000 is now worth over $5 million until he realized he had to give $2,300,000 to the IRS in a check. And instead, we put it in a deferred sales trust, and he's happy. And by the way, now what is he doing? He's taking the money in the deferred sales trust, investing in the stock market, investing in real estate, investing in other businesses, because that money is just cash, right? And we can do all the other things we want to do with it, and he doesn't have to pay taxes on it, except the poor guy has to receive $80,000 a year 4 times a year for the rest of his life. And, that's too bad. Yeah. Yeah, so it's very, unlike a 1031, we have total range of investment options that can be deferred, okay? Okay, so tax benefits are good. Next one, multi-generational. That's really important. I sell annuities. Annuities are great tools for people to provide income, but most of the annuities are generally one generation, or maybe a husband and a wife. If the husband passes, the wife gets the income, or vice versa. But real estate's something that can go on for generations, right? You can pass that down to your kids, your grandkids, and so on. There's not many investments that you can do that. You just need to teach them how to be, interested in and good managers of the real estate. So we like real estate for a lot of reasons, and this is the biggest one here, number one. I put it number 4, but it's the number 1 reason. And I bet if I asked with a show of hands if this is important to you, that you're in control, would I get a lot of hands up in the air? Yeah, you bet. Because with Wall Street, you have zero control, right? You go along for the ride. We put you in the market, we cross our fingers that we did everything right, and if it works out, it does, and if it doesn't, it doesn't, and you're not going to do anything about it. But with real estate, you have your own creativity, you have your own ingenuity, you have your own everything to make your decisions about what's going to happen to that. Personal responsibility. I wish I could remember more quotes from that guy. Wasn't he awesome, by the way? Yeah. I can't wait to show my kids that video. That was such an inspiring presentation. Yeah, I don't know what goes on in that guy's brain, but I'd like to buy some of it. It's really, really good stuff. Yeah, so control, right? Control is a big reason we love real estate. All of us agree? Yeah? Yeah, okay. What don't we like about real estate? It's complicated, right? Hard to find properties, hard to keep them, hard to manage them. It's just a messy process, owning real estate. I think we just told you, I own a property in Park City, Utah. I've owned it for 12 years. It's a vacation rental, right? Instead of having somebody check out once a year, I have somebody check out once a week, right? It's a messy thing, right? But the rewards are worth it, right? The rewards are well worth it. Another thing, it's expensive. I can take literally $1 and buy a stock. I can't take $1 and buy a house. Can't do that. That's a benefit, right? All these negatives, by the way, are benefits to us, right? Just because it's complicated, messy, and expensive keeps a lot of the people out of the market, right? Allows us as investors who will take the time and energy to get in the market. That's why the profits are there for us, right? And then the last one, this is as a financial planner, the biggest one I got to drill into my clients' heads. Real estate is illiquid, right? Liquid, right? I put my money in the checking account, I can take my ATM card and get it out the second after I put it in. It's liquid. Real estate isn't anything like that. The day you buy it, you know where you're going to pay sales commissions to get it out, title and escrow and all this other stuff if you want to sell it. You may not be able to sell it ever, right? I was listening to the gal in here, the previous speaker, talking about crowdfunding and how she was in Vegas with some of her investments. It took her 10 years to get whole on all those investments that she had there. That's how illiquid it can be, right? So again, all the reasons that are bad are really good for us as long as we're aware of them and can manage through that. Would you all agree? Right, is that a good description of real estate? Yeah. Right, all right, cool. So the secret in buying real estate is simple. I say this over and over again, the profit is in the purchase. If you buy it right in the first place, it'll probably do what you want it to do. It'll provide you the cash flow. You'll get the appreciation, whatever your objective of that particular property. If you buy it right in the first place, it'll likely do what you expect. But if you buy it wrong, you have to hope for a miracle. okay? Now, the cool part about real estate is miracles happen. They really do, right? Miracles in my area of the country are called appreciation, right? It's amazing, you know. Short little story, and this is, you know, just to put things in context. I bought a house in Corona del Mar, which is a little kind of subdivision of Newport Beach, south part of Newport Beach, in 1993 for $625,000. It's pretty decent price. I mean, it was 1993, but I sold it for $2.3 million, okay? So I didn't do that because I did any work. I didn't do that because I was smart. I didn't do that because I was anything but lucky, right, that I lived in a market where real estate values just went wacko, right? And we have, you know, clients in San Jose and Cupertino and any little place where Amazon or Apple happens to show up and, you know, there goes your real estate. Yeah, so miracles do happen, but we don't want miracles. What we want is what we bought the property for, to do what we expect it to do. And if a miracle comes along, yeah, that's awesome. We love it, okay? So, that little thing I just slid through back there, what makes it right, what I mean by buying it right, is that it makes financial sense from the day you buy it, right? It should make financial sense that day, not that if this happens and if this happens and if this happens. No. Now, that doesn't mean you shouldn't buy property that doesn't need things to have done to it. Another story, San Jose. Okay, so San Jose is like nuts. I mean, these people are absolutely nuts. I thought real estate in Orange County was expensive, and I did a presentation up in San Jose. It was like 2 or 3 blocks from the Apple headquarters there. And it's just stupid, the prices that they're paying for homes there. So this particular fellow bought a property that had a big enough lot that he could have it subdivided into 2 lots, right? And the street that he was on was a very busy street, right? It happened to be just a few blocks down the street from the owner of Facebook, you know, so it's still a good neighborhood. Yeah, good neighborhood, yeah. But that side street, the home prices were like 20-30% more in value than the street that he was on, because he was on the busy street. So he bought it. Then he went and did all the work to get it subdivided, built another house on that side street with a new address on the good street, and made a huge profit on doing that. So that's work, right? So that's part of the plan to make it happen. He didn't hope for that to happen. That was part of his strategy. That's real estate, right? You can be creative and do creative things with it. We're not talking about that today, though. We're talking about income property. So what I'm looking for is, I think I click through a whole bunch of things here. Okay, so what we're looking for is these things. Cash on cash returns, which is one of the metrics, and I'm going to get into a spreadsheet that I created to show you this. And then we're going to look at 3 other numbers: RV factor, debt coverage ratio, and cap rate. And I'm going to dig deeper on these in a few minutes. Well, let me show you this little spreadsheet here. This is live and in person, right? We're going to actually do this here. Audience participation. Okay, so when you go out and look at real estate, right, in real estate markets, you're gonna be presented with the opportunity to buy thousands of homes. That's the nature of, you know, the real estate market. Problem is, how do you sift through those thousands of homes to get to the few homes you really want to do your research on? So what I developed is this spreadsheet, so my clients can get down to really the 4, 5, or 6 properties that they really started to look then at other things that are important, like neighborhood, for crime statistics and schools in the neighborhood, and, you know, things that are important to people for living, quality of life things, but the numbers got to make sense first. So this spreadsheet, why am I still showing the PowerPoint? Maybe I have to crash the PowerPoint first. Yeah, this is a live spreadsheet. Now we see it. Okay, cool. So this spreadsheet will do this for you. So we're going to do this together. I have a $150,000 home here where I'm putting 20% down. I'm going to pause on that thought for a moment right now. 20% down versus 25 versus paying cash, okay? By the way, I'm a big advocate for self-directed IRAs. I don't know if we'll have time to talk about that later. There's a lot of reasons to not invest in real estate. And let me put it this way. Investing in real estate within an IRA is a good option, but if you can invest in real estate outside of the IRA, you're going to get a lot more bang for your buck. Why? Because you're going to get the depreciation, you're going to get better loans, you're going to get better terms on those loans. It's just everything's going to be better for you. So in general, with my clients, we try to do everything we can to find ways to get money out of the retirement accounts and in real estate. And then when they're done buying real estate with the money they have outside their accounts, then we'll start investing with the money inside their account instead. Anyway, 20% down. So leverage is really a benefit, especially with rental property, for a few reasons. First of all, it's going to increase your rate of return, right? It's going to increase your rate of return because you have less money in the property, but you're going to get the same income. Now, you got to service the debt, but I can show you the actual numbers here, what it means to have leverage in a property versus putting more money down and having less leverage. Because remember the 3 states of money, right? Spend, lend, and invest. Everything's financed 100%. So either this place is going to be financed with your money, or it's going to be financed with somebody else's money, or it's going to be financed with both. There's no choice. This is how it works, right? So we're going to show 20% down. That's a $120,000 loan. We'll need $30,000 to do that. I have a 5.5% interest rate, and I have a 30-year loan. Today, and I've been a mortgage broker for 32 years. I still do mortgages every day. Today, I'm still advocating for 30-year fixed rate loans. Why? Because 30-year fixed rate loans are still the lowest they've been in decades. When I started in the mortgage business back in, I think it was 1987, interest rates, 30-year fixed rate loans were about 15%, right? And people were glad to get them. I can remember going in front of the board of realtors announcing that 30-year fixed rate loans were just below 10% and getting a standing ovation, right? now I'm a hard money lender, right, at 10%. So 30-year fixed rate loan, you're getting another benefit because that interest rate is locked in for 3 decades. Think about that, 3 decades, right? And interest rates will go up. Your interest rate won't, but won't your rents go up, right? So that's just going to continue to help you increase your rate of return. So the mortgage payment calculated $681. You got to pay some points and fees to get that. I have place for the rehab costs, other credits. Maybe the builder's going to throw in some money for you, whatever. But in this particular example, I need $36,600 to buy this property. Pretty simple and straightforward, right? Good. Now, as a financial planner, one thing I know about real estate, again, is what? It's illiquid, right? If I buy this thing, I'm stuck with it for a while. So I want to have cash reserves on hand, right? Because what happens? Tenants move out, roofs get blown off. You could be, you've seen it, California, we had massive wildfires and floods and landslides, and there's hurricanes in the east. So, there's always stuff that happens. Nobody loses their home. They don't lose their home. They give it back. A lot of people have to give back their home because they don't have a way to survive when it's empty, right? Cash reserves are your key. So what I like to see is about 3 months of rent in cash reserves. Now, if you have 10 properties, that'd be 30 months of reserves, right? What's the likelihood that you're going to have 30 months of vacancies out of all those properties? It's like 0, right? Ain't going to happen. So it's a little riskier initially, but the more properties you have, the less risky that becomes. But I want you to have 3 months. And the reason I'm putting that in there is because, remember, 3 states of money, spend, lend, and invest. I have to have this money sitting aside, even though it's sitting in the bank account earning nothing, right? I still have to have it, and I'm going to calculate it in as part of my rate of return on this investment. So I had another $4,500. I got $41,100 to buy this house. Now, this is another really important one that I didn't get for years. When you buy a house, you get 2 things with it. You get a piece of dirt, and you get a building on top of it, right? You get a piece of dirt and building on top of it. Now, the dirt, we don't get to depreciate. For some reason, the IRS thinks the house on top of it is going to turn into twigs or sticks after 30 years, 27 and a half years, right? So they let you depreciate this house, right? It's going to last longer than 30 years. It'll last for 400 or 500 years like they do in Europe if you take care of it. But the IRS doesn't care. We get to depreciate it, right? So in areas where they have high land values, like where I live, it's just the opposite of what I'm showing you here, where the land might be 80, 90%, maybe 99% of the cost of the property, right? And the building is nothing. There was, we were talking at lunch, there was a property in Laguna Beach that was listed for sale. It was a 400 square foot house. It's like a nice hotel room, 400 square feet, okay? And it was built in like the 20s or the 30s or whatever, $14.5 million. Yeah, so it was like 99.999% dirt, and it was a card table with a beach chair, that's it. So we want to buy properties that have low land value and high improvement value because we want to get the deduction. We want to get that depreciation deduction. So I'm gonna rent it for $1,500 a month in this example. And then, as a planner, remember, we're modeling this out. This isn't reality. This is what we want to plan for. Let me hold that question for just 1 second, but just hold. We want to model out for like a worst case scenario. Again, as a planner, I always say, look, let's Hope for the best, plan on the worst, know we're going to be somewhere in between. That's fair, right? So I'm going to plan an 8% vacancy, 7% maintenance, and 10% management. I'm going to take 25% of the rent and throw it out the door. 8% means I can have my property vacant 1 month a year, right? So every year I could lease it up, have it vacant, lease it up, have it vacant, lease it up, have it vacant. 7% maintenance, 10% management, that's about numbers. But, Fannie and Freddie both want 25% off the top anyway. We're going to deal with that number. We're going to say, we're going to take 25% of our gross rents and we pretend we're not going to get it. You put in property taxes, insurance, I got a place for your HOA, and I'll skip over this part for now. So now I'm down to this number, net operating income. This is an important number. Net operating income is the number of the gross rent minus all of the expenses before the mortgage, right? Net operating income, remember that one before. Do you want to ask your question now, by the way?
Sure.
Yeah. Before I go into the next piece?
As a rule of thumb,
Yeah.
do you find that condos have a really low land value?
Yeah.
So many units on the land?
So the question was, as a rule of thumb, do you find that condos have a really low land value? Yeah, that's a tough question because technically, at a condo, you don't own any land, right? You only own the airspace inside your four walls, technically, right? In a townhome, you actually own the airspace inside your four walls plus the dirt underneath you, so you do have some land value. But you also have a common share interest in all of the land that the HOA does own. So typically what I see on tax returns is they'll just go 80-20. Across the board, right? Because again, you don't technically own any land, but because you have an ownership interest in a common HOA that does own all the land, you do have land as part of the equation, right? I kind of thought that too, but I'll just get this condo and make 100%, didn't work. About 80-20, yeah. That would be wonderful. Okay, so now we have net operating income from which we subtract our mortgage, $681, and now we have that beautiful thing, that positive cash flow of $169 a month. All that to get to $169. Oh. How are we doing on time, by the way? Pretty good? 5 minutes? Hurry? Okay. Okay. No, I think I have till, really? Oh, wow. Okay. Okay. I locked the door. Okay, so now I have my 3 little tests, okay? RV factor, debt coverage ratio, and then cap rate. So what's RV factor? RV factor is the rent to value. It's the easiest thing to figure out. Why? Because you only need to know 2 things. You need to know what it's going to rent for and what you're going to pay for it, right? How do you find out what things rent for? You can ask the person that's selling to you, and they might tell you the truth, right? You can look at the listing, but you can go to Craigslist, right, today, and I can look in any market in the United States and figure out what a renter would be looking at competitive properties around the U.S. It's pretty simple. So I just need to know what it rents for and the value of the property and get the RV factor. I want it to be greater than 0.7%. So a $100,000 property should rent for $700 a month, right? If it rents for more than that, then I'm probably going to be okay. Right? Now, you can't make this the only measurement because what? You don't know all the other stuff. You don't know if it's an HOA, what that has a $1,000 a month HOA do, right? That could really blow a hole in that RV factor, but it's a starting point. It's a way to get rid of a whole bunch of properties that you might want to not take the time to look at. Debt coverage ratio is your basically your security blanket. So I had you put 3 months of cash reserves away in case you had stuff happen, but I also want to have more money coming in every month than the mortgage, right? And I want it to be about 25% more than the mortgage. That's why it's a 1.25 it needs to be greater than 1.25. Ours is 1.248, pretty darn close, right? How do we fix that? Make a bigger down payment, right? So if I put a 22 or 3 or 4% down payment, I would get that debt coverage ratio. The sacrifice by making the larger down payment is my rate of returns are going to go down because I'm going to lose the leverage. But it's fixable. It's the only one of these 3 that are fixable, right? I can put more down payment and improve my debt coverage ratio. The final thing is cap rate. Cap rate is generally used in a commercial property, but it basically means if I own this place free and clear, right? If I spent my money now, right? If I spent all of it and I'm financing my property 100%, gross rent minus all my expenses, that net operating income, multiply that times 12, divide it by the cost of the property, and that's my cap rate, right? It's like if I put the money in the bank, what are you going to give me for it, right? So in this case, the cap rate is 6.51%. I want it to be greater than 5% in a market like this, right? As interest rates go up, that 5% will get higher, right? But if you don't get at least a 5% cap rate, and by the way, remember this cap rate is based on all kinds of terrible stuff. It's vacant once a year, you're paying all kinds of maintenance and management fees, right? I've done all the things I could do to reduce your income, and I still have a 6.51% cap rate. So if I keep my tenant in for more than 1 year, boom, my income goes way up, right? I get way more benefit of this. I just want to do this for modeling. I want to do this for filtering. Okay, so let's put this all together. And I have, on my little $169 a month, I'm getting $2,024 a year. Still not an impressive number. I mean, you're not going to retire on $2,024 a year anywhere in America, right? Not even a month. But it's still 4.9% return, right, on my investment. Because remember, I didn't invest $150,000. I only invested about $40,000, right? So 4.9%. Then I get this little hidden gem because that tenant is paying my mortgage down, right? So every month, a little bit of principal gets paid down. By the end of the first year, I paid down $1,600. I got another 3.9% of my money back. I don't get to see it. I can't spend it, but it's there, right? And by the way, it's another guarantee, right? It's not I hope I get that. As long as that mortgage is paid, I'm going to get 3.9% of my money coming back to me every year. And that number goes up every year because as I owe less, each payment pays more and more principal down. That's a cool thing too, all right? And then my favorite, depreciation, 10.6%. Wow, I love it, 10.6%. Put these, I had no appreciation, right? That's the gift, right? That's the little miracle. So we left that at zero. So in this little house, I invested $36,600, and you total this all up, I have 19.5% rate of return on my investment, $8,000 a year. That's pretty cool. You like that? Yeah. So this little spreadsheet, which is what we use with all our clients, we give you the spreadsheet, we teach you how to use it, right? And let you go shop. And I have, I think, 8 properties on here, and at the end it gives a little summary so you can compare them one to the other and see which ones look better than others. Yes, sir.
I'm just curious.
Do I really have 5 minutes?
No, now you have one.
All right, go ahead.
What's the
Sorry.
tax rate you use on depreciation calculation?
Say it again.
What's the tax rate you use on the depreciation calculation?
It's not a tax rate, it's the value of the depreciation per year. So you take the property, the building, in 27 and a half years. Divide by 20, and it's it's not a tax rate. I get that money no matter what tax rate I'm in, right? Now, for some people, if you're making a lot of money, that deduction's worth more than it is for others. But to everybody, it's worth that amount of money per year. That make sense? Great question. Okay, oh boy. Okay, let's summarize. Okay, so session 1 takeaways. Money exists in 3 states. You can spend, lend, or invest. Real estate is a great investment, but it's not a magic bullet. The 3 financial metrics we look at are RV factor, debt coverage ratio, and cap rate. We use all those in our little spreadsheet. The secret to investing in real estate, the profits in the purchase. Buy it right, it'll work. It should work. Buy it wrong, hope for a miracle. Okay? No, that's our summary here. Oh, and by the way, all this is in the book too. And then I just hopefully I have a minute to go through this. Corey, my production partner here who lives in Salt Lake, is passing out to you a financial assessment. We have 25 copies of that book out here to sell you. They're $20 a piece. There's only 25 of them, so, and I'm going to do 3 sessions with these people, so if you want to buy them now, right? Corey will take your money for that, and if you want me to autograph it, I'll do that. And Mark Kohler's here too, and we can probably get him to sign it as well if you want an autographed copy of our book. Everybody will get this financial independence toolkit. It's really cool. It's 100% free. You're going to learn about how to create a budget that won't. How many of you budget your money every month successfully? Awesome. Okay, most of us struggle with that. So I'm going to teach you a way to budget like no-brainer, works every time. How to build up your cash reserves and use what we call a 3-tiered cash reserve system. And then I'm also giving you 12 financial guides. So caregiving, how to take care of elders, college funding, Medicaid, Social Security, there's like 12 different financial guides we give you. All that stuff's free. And then the third thing is, as I said, I'm a consultant. Normally I charge $265 an hour for my time. I'm going to give everybody here 30 minutes of my time for free. And your ticket is to give me that financial assessment before you leave here. Okay? So you fill out the financial assessment, and you can just give it to us anytime today. You don't have to do it now. But you do that, turn it in, and then we'll get you on my calendar. And during the assessment, this isn't like, during the 30 minutes, this isn't like the initial consultation, but this is anything you want to talk about. You got tax problems, you're getting a divorce, not that you're getting a divorce. You're getting married, not that you're getting married. All that good stuff. Whatever you want to talk about, we'll cover it. Because as a financial planner, we're addressing all those things. Asset protection, estate planning, tax planning, investment management, all those things. So you're going to get 30 minutes from me. All you got to do is turn in your golden ticket or your green ticket or whatever color it is, and we'll be good to go. So if they don't throw me out of the room, I can still answer questions if you guys have questions.
Throw you out of the room.
Oh, come back for the next session.